Do you think you know how much home you can afford? Most first-time home buyers either overestimate or underestimate their actual budget. And of course, this can cost you. So today I'm going to bring Molly Zimmerman back from Bell Bank Mortgage to talk to us more about this. I'm Erica. I'm in my 7th year as a real estate agent, and I work, the Twin Cities market, but I primarily specialize in the Western Metro. If you have any questions about the information we go over today, or you want to get started, of course, you can reach me at the link below. So you will find my freebies, you will find the contact information, and just all sorts of other information that you might find helpful in the link below. And of course, I appreciate when you like and subscribe and follow, etc. If you're not sure because you're finding me on a Facebook group, the information is in the link below where you can get more videos. At the end of this video, I am going to share a very quick Twin Cities real estate market update. So before I bring Miss Molly on, I want to make 2 points that I think you will find helpful. And the first one is a little less significant, so stick with me. But if you are relying heavily on this Zillow mortgage calculator to figure out your affordability, I would implore you to pause. As you can see on my screen, I recorded this separately. This is the number they're going to give you just automatically. They're not plugging in any information about you. It's just a website. It's just kind of auto-populating. You need to click down on each thing to figure out the numbers that you need to go in. And if you're not working with a loan officer, I think it's going to be incredibly hard for you to punch in the right numbers. But the truth is, loan officers don't use third-party websites to help calculate your monthly mortgage. And so I would not rely on this too heavily and take it with a grain of salt. Unfortunately, just doing this short video for you, I discovered that the rates are really off, and I think that would be very misleading, making you think the house is a little bit cheaper than it actually is. And so even if you're using a mortgage calculator from a loan officer, you have to ask them the numbers that you need to plug in. Now, of course, the numbers that are the best are the ones where they're actually quoting them to you. And before you write an offer on a house, a great loan officer is going to do that number crunching for you. So you shouldn't have to rely on those tools. So anything I'm talking about should be used loosely with a grain of salt. It shouldn't be the numbers. But here's a really big thing I want to share with you today, which is everybody wants the perfect house in the perfect location and for their budget. I don't think the sentence I said should strike anybody as odd. But the reality is you're probably going to get 2 of the 3 things. And that's not to say that budget has to be the thing that you give up on. I think the reality currently is that houses are expensive and interest rates do dig into affordability. And so understanding your numbers outside of talking to professionals is going to be very critical. I have a worksheet attached in the link that you can use to get started, but I honestly do not think you need it unless you want to go there and you're very analytical. Where I'm coming with this is I think on your own, you know what you're paying for rent. And I think you know if that number is comfortable or tight or that, whatever. And so I think, you're going to have more bills as a house owner. And so without going too deep into this conversation, because I really want to, I would just implore you to think about the conversation in the simplest way, which is, let's say you found this really great house in a really great location. My question for you is, what would you pay for that per month? And only you decide that number, and you don't have to keep that number a secret. I don't know that your real estate agent necessarily needs to know it, but your loan officer probably should, because if you say it's $2,500 a month, $2,700, $1,500, doesn't matter what the number is, what they should be doing is backwards planning into that number for you. So instead of saying, well, you're approved up to $300K, what if you said instead, I'm willing to pay $2,500 a month for a really great house in a really great location. That's my parameters. That's the max that I'd be, and I hope I don't even have to spend that, right? And now that person is going to help you say that is an X dollar a month house with these property taxes, and then if there's an HOA, that needs to be calculated into it that way too. That is how I like to work with my clients. it's relying on what your numbers are versus what a loan officer says is your max or your minimum, not minimum but max. And this is just a better way to look at your situation so we don't get you in a bad situation. Let's bring Molly on now to talk about a few more points on this topic.
And I think a couple things from a lender perspective to keep in mind is that we're really going to focus on what is your credit score, what kind of income are you working with, and what are your monthly debts. We really try to make sure that we have, we keep your housing payment within a certain like bracket of your total gross monthly income, but we also don't want your total debts to exceed a certain percentage. So you might hear lenders throw out things like, we want your housing payment to be 28% or 31% of your gross income, total debts not to exceed 36 to 41% of your gross income. And really what that means is, as a lender, we're working backwards. So I'll take a look at your total gross income and maybe take the top end of that. So if your approval runs to maximum debt of 41%, I might take 41% of that income, and then I deduct whatever your monthly payments are on credit to back into what a mortgage approval might look like from a monthly payment perspective. So that's one thing that we're really looking at. And I think the other big thing is just keeping in mind that what interest rates are doing is really going to impact what your affordability is going to look like. And we can go back to, thinking about when rates were in the 3% range, affordability was extremely high. It was aggressively high, but affordability has changed a lot with rates, more in that high 6, low 7 range. So as interest rates change, your affordability and your approval is also going to change.
Absolutely. And that was like my brain went right there too. It's like that's why everybody came off the shelf in the COVID years, is the affordability completely changed. And I notice, because it's been a few years, people are sort of, especially first time buyers are like I think they're like, wow, this is so crazy expensive. And it's like, yes, this is why people came off the shelf during that time. But, as we've talked about many times before, houses weren't really that affordable, because if you had to go 50,000, 100,000 over an asking price, it was countering that. And I always think about that moment. And I'm sure you remember this, Molly, when interest rates started climbing up and how we frankly started losing clients because the prices was changing so much. It's like, yes, literally yesterday you could have afforded $50,000 more, and today you can't. And that is such a hard pill to swallow, to have somebody tell you you're actually ticking down. What a weird feeling to like be told, yesterday it was 300,000, today you can buy 250. And I remember just how angry people were during that time. And so, I think it's a weird thing to say out loud, but it's probably nice that it's been stable, just from that perspective that we're not really having these ups and downs that we had during that little window of time. But
Yeah, quick side note on that. I mean, I just want to stress the fact that, do I think rates are ever going to get that low again in my career? No, I
yeah,
would be
no.
extremely shocked. We are now in a more stable rate environment, and it's like, we are expecting rates to stay very stable over the course of a couple years. So, like, with that being said, you're not going to see that large swing, hopefully, in affordability. It's just going to depend on what the house values do. So.
Well, exactly. And so, and again, and I had talked about that before I brought you on camera, which is just we, have to know our numbers privately, so that we can work into this. And yes, there is some sticker shock right now. Like it is hard to hear that, you're renting for this, and if you buy a house, it's that. And we certainly need to anticipate that buying a house does come with normally a higher monthly payment than renting. Not always, obviously, because I don't know where people are coming from and where they're going, etc. But it's really hard, I think, and I don't know if you've noticed this, but if somebody kind of expects it to be about the same, then typically I feel like lifestyle changes in a downward way. So if I want it to be 2,000 a month as a rental, but a $2,000 a month mortgage payment, the house quality seems, I don't get a lot of privilege to see people's rentals. I'm just like getting feedback where there's this sh- little bit of that sticker shock of like, oh, this is what I get. And it's like, Yeah, I mean, again, we're not talking about anybody's particular budget here. One more thing we should hit on before we log off on this particular topic is that we haven't hit on is just other expenses that we aren't we're going to point out to you because we want to be good people. But if you're like going from an apartment to a house, you might need to think about furniture expenses that are about to come up, just moving costs. And some of that's short-term stuff. So long-term things that concern me is when people don't consider about like a fridge breaking down, the roof leaking. Maybe you need to buy a lawnmower. You've never had a lawnmower or a snowblower before. So it's really flushing out the whole budget topic, I think is extremely important for individuals. And again, it's not that we're not going to say these things, but we don't know you. We don't know if you're getting a hand-me-down lawnmower or you need to think about another couple $100 that's coming out of somewhere. But my biggest worry for people is they underestimate that you, I hate saying that, but your furnace could go down the first week you buy your house. And if there is zero money there or your car dies and now, and you got to have some cushion in there for yourself for these what ifs. We're going to do inspections. You can buy home warranties. But there are just, it's a building. Buildings change, buildings have problems. You're not renting anymore. So
Yeah,
it's
I just side note on that. I mean,
yeah.
me personally, I had a fridge, a microwave, and a water heater go out shortly after I bought a house. So
Oh,
I be prepared. Like that's not the norm, but like
no.
be prepared. Things can happen.
And I would say, like, when I show new construction, which is what I bought, there's no blinds, there's no laundry machines in most of these properties. You might not even, I didn't have grass in my backyard. I had to budget for grass, let alone if you're doing any hardscaping or you just want to replace certain things. So there's so much to talk about where more money is going to need to be spent after you buy a house. But, having some thought about this in the forward sense is going to be a huge benefit. Thank you so much for joining me, Molly.
Thank you.
Okay, let's just quickly talk about the Twin Cities real estate market. And let's start at the bottom where you can see the Twin Cities market meter. Notice that the arrow is pointing to 6.36. And last week it was a 6.23, excuse me. So it's just getting a little bit hotter. Just as an example, I showed a house at 200,000. I think it was on Sunday, and they got 12 offers. I heard of another house in Northeast around that same price point. I think I got 7 offers. So it's always good for you to know the price point is going to dictate the intensity of how many offers, how many people are out buying. The lower your price point is, and I know that you might not have context, but the closer you are to zero, maybe another way to say it is if you're between, I would say like 150 to even up to 350, but let's say 300, you're going to be in a very aggressive seller's market that's going to move even faster than what I'm describing to you on the screen. They're going to get multiple offers. There's going to be a lot of interested people because the lower the price, the more people can afford it, the more people that are fighting for it. There's a lot of first-time home buyers out shopping right now. There's investors still looking for opportunities. So it is fast-paced. That doesn't mean you shouldn't house shop. You just need to understand that it's February. There's a lot of people out there shopping. We're predicting the peak is going to be in March this year, April. And so if you're really trying to stay out of any sort of competition, you might want to wait until after Memorial Day to do some serious house shopping. Yes, there'll probably be less inventory. So that will be, the kind of one thing goes up and one thing goes down kind of situation. When you compare it to this time last year, it is a hair slower because you can see on my screen it was 6.61 at this week, but weather plays a huge factor into this time this year. It's obviously been bitterly cold. Schools have been canceled. I know my son just had a 2-hour delay this morning. All of that plays into the real estate market. If you're 250 to 500K, you should anticipate about 5 showings a week as a seller. It certainly could be more than that your first week. This is a little bit faster than this time last week. So every week changes a little bit when we compare it to last year. It is a titch slower. It was 5.41. Not too big of a deal or anything. Again, who knows? Maybe it was a warmer week than this week. Interest rates still hover around 7%. You definitely want to check in with your loan officer on your particular product and see what your situation is. Don't put, too much emphasis into that information when I share it to you, since I'm not representing a particular bank or lender. It's a little bit less money than it was, or sorry, the rate's a little bit lower than it was this time last year. And then lastly, the thing I'll point out is days on market has changed significantly over last week. We were at 45.9, now we're at 33. So again, we're seeing all that evidence that houses are selling faster. It's a little bit more aggressive for you. If you're buying a house right now, you need to expect some competition depending on your price point. And remember, I'm focusing on under 500,000. So if you're over that price point, you may have a slightly different experience. Every niche is going to have a different vibe to it. So work with your real estate agent to understand the market, because what I'm telling you might not be true in your segment. If you're shopping up north, if you're looking at condos, if you're looking at waterfront, all these niches change things. I appreciate you so much if you made it to the end. I'm here for you if you need me. Have a fantastic week. I'll see you next Wednesday.